Okay, we're just going to quite quickly summarize the rules for double entry and how to do it. So you might be familiar with the acronym DEAD-CLIC, and DEAD-CLIC basically just stands for debit expense accounts, asset accounts and drawing accounts, and CLIC stands for credit liability accounts, income accounts and capital accounts. So when those expense, asset and drawings increase, we debit those accounts. That's what the D stands for at the beginning. That means we put a figure on the left hand side of that ledger account, that T account. And for liability, income and capital accounts, we credit those accounts when they increase, or in other words, put a figure on the right hand side of that account. So that's the credit, liability, income and capital. So we can represent it like if you look at an expense account, a T account or ledger account for expense or costs that we said we would debit. That means put on the left hand side when those accounts increase. For incomes or revenue accounts, incomes we credit, or in other words, we put a figure on the right hand side of those accounts when they increase. For asset accounts, we debit them, so that means we put a figure on the left hand side when they increase. And for liability accounts, we credit them. So liability accounts, we credit those accounts when they increase. So debit stands for left hand side, essentially credit represents the right hand side. So this, you could look at it, look at DEAD-CLIC in this way, graphical way, that we have an increase in expenses, then we put a figure on the left hand side, the debit side. When we have an increase in revenues or incomes, we put a figure on the right hand side of that account, on the credit side. When assets increase, we put a figure on the left hand side or debit side of asset accounts. And when liabilities increase, we put a figure on the credit side or right hand side of liability accounts. So that's the general rules. Quick reminder, expenses are things like rent, any transaction that takes value away from the business. So agreeing to pay rent, having a landlord, renting a property, paying your utilities. So that's gas or electric. Your phone bill. Okay, so any types of utility bills, repairs would come under a expense. Incomes, so what generates value for the business, any activities that generate value, such as making sales. You might receive commission, so commission receivable. You might receive interest receivable. Those activities generate incomes or value for the business. Assets, things you own that have a value that could be sold off, essentially for cash. So this could be something like machines for a business, vehicles, property, and liabilities are debts, so things that a business owes to others. And this could be a mortgage, a loan, or a bank overdraft. Okay. So now we're just going to look, this is obviously a very short summary. I go into a lot more detail in my longer videos, a longer course. Now we're going to look at just a few transactions and see how that works with these rules. Okay, so now we're going to look at a few examples of how to do double entry. And remember, this is the shorter part. Restart. Now we're going to look at a few examples of double entry and just remind us of the rules. If you remember from DEAD-CLIC, that we debit expense accounts, asset accounts and drawing accounts when they increase. So if I had an expense ledger account like this, I would debit it or put a number on the left hand side when that expense increases. And that means that implies when the expense decreases, I put a number on the other side. For incomes and liabilities and capital, we credit them when they increase. So when an income account increases, I'm going to put a number on the credit side or the right hand side, and therefore when an income decreases, I put a number on the left hand side. And then liability accounts similarly increase on the credit side or the right hand side. So when liability like a loan increases, I put a number on the right hand side and reverse on the left. And assets, I put a number on the debit side or the left hand side when assets increase. So when an asset account increases, I put a number there. When it decreases, I put the number there. Number one, when an owner of a business introduces 50,000 capital to the business, the double entry, I'll do this in blue so you can kind of see it on here. So it introduces 50,000 capital. So a capital account, as you can see from here, we credit or put a number on the right hand side. So I have a capital account here, so I'm going to put the 50,000 there. And what else is happening? So remember, every transaction has a dual effect. For every debit, there's got to be an equal credit in another account somewhere. So if I'm crediting the capital account, what else is happening if an owner is introducing 50,000 into the business bank account? Well, the business bank account is going to increase. The business bank account will have more funds in there. And a business bank account is usually, hopefully, an asset. It has a value of money in there, which is an asset for the business. And assets work like this. So they increase on the left. So I've got an account for business bank, and they increase on the left, decrease on the right. So now the business bank account is increasing with a value of 50,000 that's been deposited into that business bank account. So that business bank account, which is an asset, is increasing. Take out a loan. Now the business takes a loan. Now that loan is going to go into the business bank account. That business bank account, that asset is going to increase. So I put a number, the value on the debit side, and we have a loan account. Now a loan account is a liability. We owe, if the business takes a loan out, it owes money. That's a liability account. That's a liability that we can call it loan. And liabilities work like this. They increase on the right and decrease on the left. So now, if the business takes out a loan, the liability of the business, the loan, has increased. So I'm going to put that figure on the increase liability side on the credit side there. Okay, next one. We buy a machine. The business buys a machine with cash from the bank worth 10,000. So I have a machine account, a ledger account for machine. Every asset will have its own account. Every expense will have its own account. Every income has its own account, and so on. So we have an account called machine. This is an asset account. A machine is an asset, something a business would own to use within the business. Assets work like this, so they increase on the left, decrease on the right. Now, the number of machines, the value of machines is increasing since we're buying a machine, so the business owes more machines. So we're going to put a number on the debit side or the increase side for machines, and that was for 10,000. And we've paid for it out of the bank. What else is going to happen then? We're going to lose money from the bank. The bank asset's going to decrease. So I put on the bank asset decrease side 10,000. Remember, every transaction has dual effects. A debit has to have an equal credit somewhere. So I've just debited the machine account, I've credited the bank account. With the loan, I debited the bank account, I credited the loan account. So you can see that this system works. Next one, we now pay back 3,000 of the loan. Now, pay back 3,000 of the loan, the business bank account balance will decrease. So the bank asset will decrease. So I'll put a figure on this side for 3,000. The loan liability, how much we owe, if we're paying back the loan, this particular transaction of paying back the loan will decrease the liability. So I put a figure on the decreased liability side of 3,000. Now on this loan, we only have a value of 5 remaining. Okay, so next one, we pay repairs expense. Expenses work like this, so they increase on the left. Now I've got an account for repairs, which is an expense account. And expenses work like this. They increase on the left, decrease on the right. Now, since we're being billed for repairs and we're paying it, it's cost us some money, it's cost us value. So I'm going to increase my expense. I put a figure on the debit side. Now, since I've paid a repairs expense, I will lose money from the business bank account to do that. So the business bank account asset will decrease, so I'll put a value on the decrease side. Remember, every debit has a credit. We've just debited that, credited that. The system seems to work. Okay, we make sales of 2,000. Sales is an income. Every time we make a sale, we add value to the business. So, and incomes work like this. If you check back to here, incomes increase on the credit side or the right hand side. So now we are making a sale, we've increased our sales, we've increased our income. We're going to put a figure on the increased income side of 2,000. Now that is paid into the bank, so the bank asset is going to increase. I'll go to the bank account, which is an asset, it's going to increase. I'll put a figure on the increase side, debit side. So again, I've debited and I've credited a different account. Last, we've got 2 more. Make credit sales. Now, credit sales means you make a sale, but you don't get paid at that time. So again, similarly to a cash sale, which we actually made a sale again, but in this case the difference is not the sale has happened just similarly to the first time, but this time what we don't have is we don't receive cash in the bank. So a credit sale again is making a sale to a customer similar to a cash sale, but you don't get paid at that time. You will hopefully get paid later. So the sale has still happened just like we just did last time. So our sales are increasing by 1,000. But now we do not get paid into the bank. What we have instead is, if you make a sale to a customer, imagine what that is. You make a sale, they don't pay you at that time, so you are now owed that money. So what you have instead of a bank asset is that you have an asset where somebody owes you money. And we call that a trade receivable. Okay, so I need to create an account for trade receivables. So trade receivable is essentially someone who owes us money because they've taken goods from us and not paid at that time. And a trade receivable is an asset. And assets work like this. So we have just increased our asset. We have now more people owing us money than we did prior to this transaction taking place. So the asset increasing is on the debit side. So we now have another debit and a credit. Okay, so last one, we buy a vehicle. Now, like we said before, every single asset will have its own account. So machines is an asset, it has its own account. Vehicle is an asset, it has its own account. But machines and vehicles are both asset accounts. So I would label this vehicle account also an asset, but it's obviously labeled differently. We would have different ledger accounts with different expenses. So this is a repairs expense, but if we also had to pay our electricity bill, that would also be a separate ledger account, and we call that electricity, but it would also be an expense and work the same as this one. Okay, so now we got a vehicle. We buy a vehicle for 7,000. So the vehicles account, which is an asset, will increase, and it increases the left-hand side. So I'll put a number, the value there, 7, and presuming we're paying for that at the moment, then we would say that the business bank account, which is an asset, will decrease. So I'm going to put the value on that side. So that's just me running through a few examples of double entry.